Good morning, traders. Today is December 17th, Saturday. Early in the morning, a little cold out here in California, but we're going to go through the markets anyway. Okay, this is a ES weekly chart, an S&P 500 E-mini futures weekly chart. And what I want to highlight again, ladies and gentlemen, is the fact that we've seen a very broad A, B, C, D, E wave correction to the downside, followed by this recovery wave, bullish wave here, which is apexing. And if you have been following me for the last couple of weeks or months, you already know that I started predicting the weakness in the market back over here in August and September, when my custom index chart started showing broad market weakness. Started warning everyone to pay attention, to start protecting long trades, look for exit triggers, moved our cash allocation to 80% allocation back over in this area, and we rode out most of this correction very safely protected in cash. Now we've seen a fairly broad correction in the market, about 30-some%, and we're getting into this flagging formation. We're seeing a fairly good recovery, and I'll show this to you on the custom index charts coming up. But what I really want to highlight today is the extended flag that is setting up right over here. We're getting this big volatility. Let me spread this out and show you. This week we've had this big, broad, volatile candle. And if you remember a couple weeks ago, I mentioned that I thought as we were nearing this resistance channel, this blue channel right here, I mentioned that we would move into kind of a sideways trend. I expected some big upward movement on or after the 13th, which was just last week. And we had some big movement to the upside, followed by a big recovery back to the downside, or a sell-off to the downside. And what we're really talking about here, folks, is this is volatility at a flag apex. This is the apex of the flag right here. You can see this little yellow line back here behind here. There's a very broad apexing formation here. So now we have to be cautious of this flag. Okay, we've got an A, B, C, D, E pattern down to here. So we've got a completed 5 waves, it looks like, down to here. Now we're in an upward wave here, and you can see here almost an A, B down to this low, and then possibly a C, D wave here, possibly going up to an E wave, maybe somewhere up into this area. But we could just be an A, B, C formation up to here, resulting in another downside move, which could come back down here. So if I were to draw this, I need you to be aware that we are in a flagging formation. As long as this resistance channel is providing some downward resistance to the market, there's a higher likelihood that we're going to see some sort of a downward move, possibly back down to this area or possibly back down to this area, which is our ultimate support, before we try to find some upward trend. Whereas if this is a washout flagging formation, then somewhere near Christmas we're going to see some sort of an upward move like this, attempting to move back up above these highs up into the 4,400 area. So where we're at with this is very interesting. We've got this big broad volume, and we've got this roll to the downside. We may see it flush out a little bit more and attempt to move back flat around Christmas, which is only a week away. But I believe we're still going to see an upward trend out of this. I believe we're seeing basing and consolidation in the U.S. markets that may lead us into an upward trend. We do have to be cautious, which, again, if you follow the system, the process that I try to teach you is the MENT rotational modeling system right now is 20% into stocks, 25% into metals, precious metals as a hedge, at 0% into bonds, and the rest of it, which would be about 65% into 55%, excuse me, into cash. So we are very safely protected against any risks in the market. This gives us the ability to still trade. I'll explain to you why I believe there's a good opportunity for trading. But you have to stay cautious right now. And I also want you to be aware that this flagging formation right here, this big volatility, is going to resolve itself one way or another, either back to recent lows, back down into these areas, 36.63 to potentially 35.35, or it's going to resolve itself and break out to the upside, which is what I believe is going to happen going into 2023. And it's going to start to move above 4,100, and then above 4,200, eventually above 4,300, and attempt to move up here. Give you an example of why I believe this is going to be the case. So the A move, if this is an ABC pattern, we'll draw this a little bit different so you can see it. Let's pick a moderate green color, modify the thickness, and change the style, and of course we'll leave that there, and then we will duplicate it, and we will try to highlight. If this is our bottom, then wave C or wave 2, remember this would constitute an A, B, C potential wave here, coming down to form wave 1. This would be potentially wave 2 low somewhere in this area. Wave 3 has got to be bigger than wave 1, typically. So in this case, we're talking 46, 4,700 potentially as a much higher high. That gives us an idea of where we're suggesting this potential wave C upward move. Now, if this is a continued downward extension, understand that this would be basically a 5-wave move to the downside. Here, we would have a moderate correction here. We would technically, in order to have to see a new wave to the downside, we would have to see some sort of a further upward correction. Now, granted, we could see it roll over and break to the downside, but ideally we would see some sort of a higher correction back up into these areas, possibly the 43 to 4,400, and then roll over back to the downside. That would be a more cohesive wave structure from a weekly standpoint. But ideally, if this is the bottom, which I believe is really the case, and this is wave 1 to the upside, then we're going to have a slight correction here, which is about a 25% correction to the downside, followed by a bigger move to the upside, and that is going to lead us to a larger appreciation rally into Q1 and Q2 2023. So in reality, this is more than likely going to last into April, May, June in this area, and potentially end up retesting all-time highs back over here before it potentially consolidates down to the downside and then attempts to move into a wave 5 formation. Oops. A wave 5 formation even higher. So this is kind of where we're at. I'm seeing this as a big flag volatility. I wouldn't call this an inverted hammer because of the size and shape of this candle. This is a long upper wick candle with moderately heavy volume. Remember, this is the end of the year. You're going to see tax loss selling take place. You're going to see consolidation. You're going to likely see some volatility. The Fed just raised interest rates again, meaning that there's a lot of traders that are positioning for early 2023 right now, which is only a couple of weeks away. And that's why I think we're going to flag into us a little sideways trending, maybe a little bear flag, maybe something kind of like this, where we move slightly downward, kind of like this, before a December 25th, 26th area, like right in this area, somewhere right in this area, start to move back up to the upside and begin our wave 3 rally, which I believe will move us above 4,600 on the S&P chart. So we've got to be cautious. We don't really need to do anything in reality. The MENT rotational modeling system has already protected us. We have the ability to trade the TT scanner and the live trades algos with our 10 to 20% allocation for stocks, Everything else is very well protected. We're waiting out this market. We're not taking any aggressive moves in the market right now, and we're letting this sideways channel play out. So again, this is my view on the S&P. We're going to see what happens. Like I said, I see this as a big flagging formation with a little bit of consolidation, possibly setting up like 2018, where we had that deep low bottom just on the 24th. We could see a very big move to the upside just before or just after Christmas as traders try to anticipate this move. And looking forward to Q4 data, I think Q4 data is going to continue to perform moderately well. Remember, revised downward earnings, but still positive earnings are positive. Now, granted, they're not as, somebody makes $6 billion a quarter, hypothetically, and now they've revised it down to 5.7. Yeah, that's a lower income level. That shows contraction in the economy, which is what's happening right now, but it's still showing a net positive. And that's, again, where I think this whole resolution of price trend is going to take place in early 2023. I think all of these scenarios are going to have played out. I think we're going to see moderate strength in the U.S. dollar still. Remember, I predicted the U.S. dollar would stay above 103 to 104, potentially strengthening around 105.67. And we've seen that kind of hold up over the past 4 or 5 months while everyone was predicting that it would tank, the dollar would tank. I think the dollar may weaken into second quarter, third quarter 2023, maybe down to 101, 102. But understand, I think there's still moderately strong strength in the U.S. dollar. I think the U.S. dollar is a safe haven. The U.S. stock market is a safe haven. And a broader unwinding period is likely to take place. This trend is not going to be a rip your face off type of trend. This is going to be more of a moderate melt up if it happens. Whereas if we see some sort of a breakdown event coming down into these lows, this could be a 2, 3, 4 week type of a breakdown, again trying to reconsolidate down near these lows. Now, I do want to highlight the key support. Ladies and gentlemen, we've got very strong support going all the way back to this level, and I'm going to highlight this in a different color. I want to make sure that you guys can see this. What color should I make it? Fine, bright purple. Understand that we have very strong support right here, right on this bright purple upward sloping level right here. So we would need to see literally this level taken out to understand that we have broken a very long-term and nearly 9+ year trend line, which would then indicate that we are now in a new, deeper bearish trend. Until that level is taken out, we are in a correction, which is why the rotational modeling system is part of the reason why it's staying bullish right now. And understand that these are key levels. These support zones right now are providing upward pressure to the market where a recovery may take place. Now, it may take many months to get back up above new all-time highs, but we are consolidating in a flagging formation with what I believe is an ultimate wave 5 move to the downside right here, starting potentially a new wave 1, 2, 3 to the upside potentially. We'll see how this plays out. This could still resolve in an A, B, C, D, E wave, then a correction, then another wave higher. But long and short of it, ladies and gentlemen, this volatility that we're seeing right here is apex volatility, in my opinion. We need to ride this out, stay protected, wait for the trend to resolve, and wait for the rotational modeling system to actually tell us where we're headed and what we're going to do with regard to price trend. So this is, again, a hurry up and wait scenario where we just wait and see how this resolves. Now, going to the custom index charts, we're going to go backwards this week. We're going to go first here with the custom volatility index, which, as you recall, a couple of weeks ago, we were watching this trend. I indicated how we had reached a fairly low, moderately bearish period, and we started to see this correction back to the upside. This indicated bullish strength, gaining strength as we move forward. We ran up into this resistance zone. We reached an apex a couple of weeks ago, a peak, rolled back over, still considered this moderately bullish. And you can see all of the selling, all of the deep index selling that we saw last week resulted in a little white candle here closing out at 884. So where are we in the terms of scope of bullishness or bearishness? I would say right now we're probably in the 65% bullish, whereas we would have to get down below this 8 level, 7-8 level to move back into bearish trending. We are dipping a bit, but as I mentioned to you, we've had quite a bit of volatility from up here around 11.40 down to 8.84 over the last couple of weeks. This would represent about a 5.5% volatility. We are still in an uptrend. We are still showing higher highs. Essentially, we've seen some recent lower lows here, but we would need to get down below 6. So we got to watch for a potential pullback here. These two blue lines here indicate that we could see a change in direction. So we have been moving downward. You can see these are Fibonacci time price cycles, and I've highlighted them differently between this 3.205 and 3.576 level. But I want you to be aware that we were in a downtrend here at the end of a cycle. We moved into an uptrend here. We reached an apexing period right here, April, May, June, July, all the way through October, or let's call it September of 2021, which was indicating there's going to be a change in trend potentially in this area. We then rolled into a final peak, into a downtrend, and now we're rotating into this area, which is telling us there could be a change in trend. So we're in a downtrend, indicating we could have a change of trend setting up. My opinion is this is going to move into a bullish trend into 2023. This rotation, this inflection point tells us that we're likely moving into a broad change of trend from bearish into bullish. Okay. Now let's go over to the valuations index chart. It's consolidating in a flat sideways motion. This is actually pretty good. We've seen an upward trend in valuations recently off of these deep lows. There's nothing saying that we couldn't come back down and retest some of these lows. So be aware, we could see this roll weaker into a sideways flattening formation into early 2023. But this upward movement here is indicating that we're seeing some valuations strength. Stock market is anticipating price appreciation off of these deep lows, and you can see these match some of the deep lows we had back in 2018, 2019. This was the 2018 period I was talking to you about, where we had that deep bottom and then we moved into a rally phase in 2019. We could see a similar type of scenario here, not necessarily seeing the deep bottom, but we could move into a rally phase and could move back up into this potentially 80, 83, 85 area from where we're at roughly 57.20. That would mean that we could see a 20-25% move to the upside. Next, we have the U.S. Stock market index chart. You can see this last rotation here to the downside was quite, let's call it sharp. It still formed that inverted hammer-shaped candle. We have that apexing type of pattern. We're getting into that volatility phase. I believe this was a reactionary move to the Fed. I believe there's no real trend bias to this. I think the Fed raising interest rates was fairly baked into the market, but I believe that the markets moved downward after the Fed move into the end of the year, and I believe it's anticipating continued pressure on consumers and asset prices, such as houses, unwinding of the credit markets. But again, we're still in this deep lower channel. We've seen this low here set up. I believe that we're looking at this support channel, this cyan color line running right across here as key support. We'll see what happens next week. As we move into this apex, this is a very solid apex formation right over here. I need you to be aware that we're likely going to see some volatility in this area before resolving into a trend. I believe the trend will be to the upside right now. but I could be wrong. So we're going to kind of wait this out. Remember, we're safely hedged and protected, so we don't need to really worry. We're waiting for the markets to find some direction so we can start deploying some of our capital more efficiently. The Smart Cash Index, which is more of a global index, you can see has rallied. I should extend this line down here because we're now at this level and trying to break above this level. So the global Smart Cash Index is kind of in the same scenario as the U.S. markets. Although we've seen some weakness here, it's not as aggressive as we've seen with the U.S. selling. The European Central Bank is still raising rates. We have seen a very deep correction back down near COVID lows. I believe this is going to resolve to the upside in 2023, a mild reflation trade, possibly back up into these areas or these areas here in 2023, but we will see how this plays out. Remember, we've seen these markets contract to levels equal to essentially a global shutdown. Okay, now central banks are trying to erase inflation or combat inflation. That's going to present an unwinding of the economy, but the economy is still going to function. How is it going to function? In what form? That's where we're at. We've seen this unwinding. We've seen the Fed and the European Central Bank and global central banks kind of make their moves. Now I think we're going to see some sort of a settling event, let's call it a resolution event, where we start to see what the next year looks like in terms of economic activity, growth, and actual performance. And I believe we're going to see a reflation trade back up into this 160, 170, maybe 180 area on this Smart Cash Index. That would reflect about a 15 to 20, maybe 25% reflation trade in the U.S. and European markets. Okay, the Custom Metals Index is stalling back out last couple of weeks. Now, this is giving us a real key here that metals in their own have broken through this channel, have recovered back above this key support level, but have stalled out the last couple of weeks. I believe we're going to see and I mentioned this to you in a video, very similar to the 2003, 4, 5 type metals market, where the U.S. markets are going to base and start to recover after the 2000 and 2001 .com and 9/11 terror attacks. If you were around at that time, you have to remember that the markets were struggling in 2003 and 4 for some real strength. They did eventually move into kind of a moderate melt-up phase, leading to the 2006, 7, 8 global financial crisis. And I believe that's similar to where we're at right now. Metals at the same point in time based and started to melt up. They moved up over 300% from the 2002-3 bottom to the 2005, 6, 7 peak. And I believe that's where we're at right now in the metals index. So if we were to see that same type of melt up in metals over the next 2 or 3 years, we'd be looking at, $5,500 gold, possibly higher. And we would be looking at approximately $65 to $70 silver, possibly even higher, as a base before the big explosive speculative phase peak starts up. And that would send gold and silver skyrocketing another 2 to 300% higher from those levels. That could put gold up above 10, 11,000, could put silver up above 150, 160. And that's really kind of a 5-year, 6-year plus outlook. And those apex peak levels are probably somewhere around 2028, 2029 for gold and silver. So about 6 or 7 years out into the future. Of course, this trend to the upside is very solid for metals. I'm looking for it to continue. We do not want to see a correction back down to these lows, although it could happen. We want to see this continue to try to melt upward. And it could take, again, many weeks and many months. So don't expect any explosive moves yet. This is kind of a slow melt-up trend in metals right now. The FANGs Index. And I have to apologize, the TradingView changed some of the data, but it still presents the same type of scenario. So we've had this deep, deep low back here, 2019, off of this standard deviation range. We had the COVID crisis down here off of the standard deviation range. And then we've come down here very close. On the old chart, it actually touched this perfectly off of this standard deviation range. And now you can see this flagging formation here. We are at risk of seeing the FANGs index and technology move a bit lower and retesting these levels here. But this would still be a flagging formation if we stay above this channel here. And this leads me to believe that we're going to see a resolution to the upside into 2023 again. So be aware that we're really sideways flagging, and that's what I've been telling you now for 3 or 4 weeks at least, that you know it's melting upward. It's a wave, beginning of a wave 5 to the upside. The real reality here, though, is that we're in the end of the year. People are anticipating some type of a new trend. There's a ton of people that believe it's going to be bearish. I believe it's going to be to the upside because the economy generally, unless there's a massive catalyst, will resolve itself to the upside. But we just need to see how this plays out. Right now, safely protected against risk, still being able to trade, trying to look for some good opportunities into 2023, which I believe technology is a pretty good opportunity moving into 2023, gives us an opportunity to kind of position with what I would call anchor trades, small allocation, small position size anchor trades, swing trades into 2023, where we may see a recovery from this 284 level up to this 350, 360, 370 level into 2023 would be, you know, opportunistic to say the least. But we're not being aggressive right now. We're kind of just sitting and waiting and watching for the broader swing in the markets to take place, which will likely happen in early January. The custom metals trend index, which is the new trend system that I've created for precious metals, is showing that accumulation is taking place on a fairly strong basis. I expected it to stall out here, maybe retrace a couple of weeks back. Didn't happen. We're still seeing accumulation to the upside. Very solid upside move here. This will drive metals prices higher. We need to see what happens here as we start to move higher. We need to get up above these high price levels, the 618 level way up here. But understand that we are seeing very strong accumulation here in metals with this custom trend index, which will eventually translate into upward movement in silver and gold and platinum. So I showed you just a little bit ago that silver and gold were relatively flat, although silver is moving quite nicely. Be aware that this continued accumulation will eventually attempt to breach these highs here, and that's where we could probably see a very big upward move in gold and silver. Right now it's kind of stealth accumulation in metals, which is great to see. I mean, this is fantastic to see. And in reality, ladies and gentlemen, we'll probably end up somewhere up in this area by February, March, I would imagine, indicating that metals will be moving higher, continue to melt up, like I told you, just like 2003 to 2005, where the stock market moves higher, the U.S. stock market moves higher, indexes start to base and find some support, and metals start to accumulate as well, leading to an apex type of a peak, speculative peak in 2027, 28, 29 type scenario. Okay, the commodity gold index flattening out. This is actually very good to see. We're not seeing a broad amount of weakness. We are not likely going to come back down here into these COVID lows area. This is because this was a global shutdown. We are seeing unwinding of commodities. I see people talk all the time about oil moving lower and lumber moving lower, and well, you know what? The Fed and the global central banks are trying to unwind inflation. So what do you think is going to happen? Commodity prices, particularly for lumber and certain core materials, are going to eventually drop as people are not buying houses. Builders are slowing down. Oil demand is weakening, and the reason oil demand is weakening is there's plenty of supply, and consumers are trying to be very cautious about spending and traveling excessively. So we're going to see this flatten out, but we have seen a bit of a recovery. We are back into moderate upward trending into these areas. You can see back here 2018-19, if we get a moderate inflation trade, we may see this move up above 4 or 5 or 6 from these current levels. And that could happen near the end of 2023, maybe into 2024. What I do expect in 2023 is a potential rally above this 2.2 area, maybe up into this 2.7, 2.8 area, possibly a little bit higher, kind of like this area here. And this is exactly that 2018 low. December 2018, we saw a nice little reflation trade before we moved into 2019, and we stayed in this reflation mode up until COVID, where we saw the deep collapse, then we saw the speculative bubble. I would expect this type of move somewhere up here in the 2.5, 2.6 area by Q1, Q2 2023. That would be a reflation trade, and that would show that we're getting some type of accumulation into the markets and into the commodities, meaning the global economy is continuing to tick along and shows some moderate accumulation or price recovery. So understand that lumber and oil may bottom in 2023 at some point and start to move a little bit higher, 1.8, 2.0, 2.3, somewhere in that area by maybe June, July, August of next year. Okay, the volume ratio chart shows us that we are moving into kind of like what happens almost every year around Christmas, kind of into a flat mode. So here we have 2020 right before COVID. Here we have 2021 right after COVID, or the end of 2020. This is 2019, sorry. Here we have 2022 where we had the tightening and then the big trend reversal. We're flattening out, and as this volume ratio index continues to flatten out, we may see a big spike. We may see some sort of a volatility spike, maybe a little down spike here followed by an up spike, kind of like we had right here. Be aware that as we get into this narrow trending and narrow consolidation, we could see some sort of a spike pattern set up. But overall, I expect the volume ratio to continue to weaken. We're not seeing massive accumulation in the market. We're not seeing big trending. We're just pretty much sliding into the end of the year with no real trending, and that's going to potentially create some big volatility as liquidity kind of dries up in the market. So watch out. We could still see some big price bars with moderately low volume. Okay, the leading index, weaker a bit last week. You can see this is really more of an inverted hammer type of formation right here. We have recovered off of these deep lows. We have moved back up into this upper area. We do have kind of an inverted head and shoulders potentially setting up if we get a little downside move next week. But I do expect this to stay in a fairly tight range, sliding into the end of the year, possibly moving upward, as I told you, near December 31st or so, after Christmas, before the new year, and sliding into an upward melt up into 2023. I do expect this to move back up into this 2.2, 2.4 area and kind of waffle around in a accumulation phase. I'm calling this an accumulation phase, an early stage accumulation, kind of like what we had right over here, or what you can see here. This was the December Christmas low in the market. Remember, it happened pretty much right here. But notice how we had that selling taking place in 2018. Sorry, right here is 2018. We had that selling taking place in 2018. Then we saw the accumulation take place off of that low, and then it moved into an actual upward trend off of this area. So we're kind of at that same level. We've had the accumulation start to take place. Now we're sliding into a bit of a sideways trend, kind of like right over in this area. And then eventually, if this continues to just melt upward, you're going to see, like we saw in 2019, 2 to 4% accumulation per quarter, or more in the S&P, and that's going to be a fairly consistent year for traders if that melt-up trend continues. So be aware that we've had the accumulation, we've seen the end-of-year type of consolidation, and now we'll likely see some sort of melt-up going forward. Okay, the U.S. Valuations Trend Index. This is a very handy little chart. for telling us exactly how we should interpret some of the other charts. So we just looked at the leading index. We looked at the volatility index. We looked at the commodity to gold index, the valuations index. But what we're seeing here on the U.S. valuations trend index is a flattening, a basing, a flattening. We've got a doji, we've got a hammer, we've got a small black bar here. Again, it's only half of December. This would be considered a black spinning top. And we're consolidating above this level, which we have been consolidating now for many, many months. We had come down and tested the level right here. We came down and breached it briefly, tagged the 50% retracement level of this range. Now we're consolidating in this range into the end of the year. Okay, we are getting some trending here, consolidation and divergence. Pretty soon, I think we're going to start to see a real move back to the upside. Consolidated as it may be, we're going to start to see a bit of a melt up to the upside, leading into something into 2023 that looks more like 2019 melt up or 2003-04 melt up. And as long as we do not see that continued selling pressure come back, of course, if the markets were to tank, it would take out this level, this purple level, to the downside and start to move downward again. But as long as we don't see that, we are essentially consolidating into a base bottom. And remember, economies by their own nature tick forward, continue to operate around the consumption or the assumption that profits are going to be made and delivered to the corporation, which in turn is delivered to shareholders and through dividends. So we need to understand this is a very big, broad unwinding phase. It's a pretty good size compared to previous unwinding phases. And now we should see some sort of a melt up, I would think, taking place as long as we protect and stay away from these lows. The U.S. to custom global market index, U.S. in blue, global market in red. Be aware that the U.S. market is rolled over off of these highs. You can see back to the downside. The global index has not. There have been a couple instances where the global index has outperformed the U.S. market index. We may see the global markets actually rally a bit higher moving forward over the next couple of weeks, whereas the U.S. markets flatten out. And that could very well be that the global markets have seen a more excessive collapse from roughly here 60% down to minus 11%. You need to understand that is a very big collapse compared to the U.S. markets here, from roughly 130 down to 65, let's call it. This is about a 50% collapse. This is about a 75% collapse in total percent value. So be aware that the global markets are trending upward. The U.S. markets are consolidating. I would expect this global market index to find some support and maybe try to move a bit higher before the U.S. markets trend a bit higher. And because, again, these global market indexes have been deeply pushed under pressure, we may see a reflation trade take place in the global markets ahead of the U.S. markets going forward. They will move in unison. So understand that even if the global markets start to appreciate faster than the U.S. markets will appreciate typically at the same time or the same manner. The area where we have to start to get worried is when they diverge in trend. Like, for example, right here, when the global market started to depreciate ahead of the COVID collapse, you can see that we had, this was 2018. You can see that the U.S. markets kind of rallied up a bit higher. That's because of the strength of the dollar and the strength of the U.S. economy at the time. Then we had the 2018 collapse. Then the global markets never really recovered while the U.S. market recovered before COVID. Then we saw them moving in unison. Then the global markets peaked 2021, early 21, and started to weaken in June, July. This is what warned me that, look out, we need to start protecting our capital back in June, July, August of 2021. Now we're seeing the global market start to rally. It's actually broken through this slight little trend channel here, but we're still struggling with the broader channel here. The U.S. markets are struggling as well. But overall, I see this as a deep, deep collapse, possibly melting into an upward trend, and that could mean that we could see the global markets recover faster than the U.S. markets, but the U.S. markets will likely trend higher if my assumption plays out. If the global markets move higher, the U.S. markets will eventually trend higher as well, as a more muted melt up trend, because there is a deeper devaluation here. There's going to be a broader reflation trade. There is a more moderate devaluation here. There's going to be a more temperate revaluation trade, more than likely. Okay, the custom tech ratio. This is a measurement of technology compared to historic trends. We are still basing in this lower pattern. This is very deep, deep lows. Remember, this is back into 2013, 14, 12, 13, 14 levels. We need to be aware that a breakdown in technology, if something were to happen, technology could weaken. I do expect it would weaken back down into this, let's call it 0.27, 0.26 area. I don't believe we're going to see a big, big breakdown in technology at this area. I think technology continues to weaken. It is in a downward trend, obviously, but this basing bottoming formation looks very opportunistic to me. I'm just waiting for some sort of a confirmation. And as I've been telling you, as we reach lows, it may not be a bad time to take small token positions in some technology companies that look good. For example, Tesla, Microsoft, and others might be a good time to kind of take advantage of these deep, deep lows and get involved in a small token position, something that you can live with in the event that another 10 or 15 or 20% downside move takes place. Because as I mentioned to you, we need some, in order for some broader catalyst to take place or broader breakdown in price, we need some sort of a catalyst, in my opinion. The Fed is acting as a catalyst to deflate inflation and the speculative bubble. But technology continues to make money. These companies have now moved into a scenario where unless the global economy moves away from technology sector and technology revenues, then we're going to see these revenues continue in some way, shape, or form. They may be smaller than expected. They may be smaller than, and they may be revised to the downside, but they're probably going to continue to show profitable trades, profitable quarters going forward. So this deep, deep reflationary or deflationary trend here, meaning we've gone back to 2012, 13, 14 areas, lows, could be a very opportunistic area for skilled traders looking for that next reflation trade. And I believe it's just going to be a matter of time, ladies and gentlemen. I believe this bottom will hold up. I mean, we've already unwound 65% of this index from these highs. It would not be uncommon to see this move back into this 0.40 or 0.43 area from where we're at, which would be essentially a 25 to 30% reflation trade up into this area. So that's, again, my thinking with regards to this index. It's been basing and bottoming. It could move very strongly to the downside, but that would have to be some sort of a big catalyst event taking place. And I'm not seeing that happen right now. Okay, the custom market timing and fear index. Fear index has moved a little bit higher last week. This is an inverted fear index. It's at 7.62. Roughly 7.05 is where I've drawn this green line. This is an indication that fear is starting to, traders are starting to fear the outcome of what's going to take place here. So this gives us a little bit of an elevated, let's call it, if we were to consider this kind of an air raid warning, this would be the first stage air raid warning, saying that fear is elevated a bit in the market. We do have the S&P 500. You can see up here is slid sideways, still in a downward trend. We'll see in an upward trend here with this purple line, but overall it's flagging, as I showed you. This is the U.S. leading Bradley Custom Leading Index. still in an upward trend, has not moved down like the S&P. We've got this nice inverted hammer formation. We'll have to see how this plays out. Remember, going into the end of the year, I don't think we're going to have a catalyst. I think the Fed has made their move. I don't foresee anything massive happening over the next 3 or 4 weeks. I think we're just going to slide into the end of the year, and we're going to start to get a better picture of what Q4 is going to look like over the next 2 or 3 weeks. So we are safely hedged and protected. We have more than 50% of our capital in cash. We have a small trading account amount for stock trades, and we have most a position in metals to hedge protectively. We just need to kind of ride this out. Don't worry about this fear index right now. It doesn't indicate anything major, in my opinion, unless we have some major catalyst, extended war, crisis, what have you. I think we're safely going to slide into the end of the year. We'll see what happens. The gold monthly index charts continuing to show more accumulation over here in gold. This is a very good signal. Remember, we have the trending index moving higher. The metals, custom metals index kind of stalling in a sideways trend. This is showing accumulation. This is telling us that metals are starting to accumulate base and actually start to move back to the upside, which is what we want. This is great accumulation every single month here since pretty much all of 2022. The beginning of 2022 showed weakness. This was deflation or depreciation, disbursement of capital against metals. This is now accumulation of capital into metals taking place. We are down here near these lows. We need to see this hold up and start to move a little bit higher. But I believe this is a very solid signal for accumulation in metals. I believe the base and bottom is in. We'll see. But we are looking at a broader 3 to 5 year structure to see the actual speculative peak. Remember, this is the speculative peak. We see it rally like freaking mad, and then we see it disperse back out. So we are looking for that next phase, that next big accumulation phase, and then we see the disbursement. Now, during these dispersing periods, you still see gold and silver rally higher. So this is where we need to, when we start to see this move downward, gold and silver are moving higher, this is where we need to start putting stops in and looking to offload some gold and silver before the peak actually happens. The global asset index is stalling. This is a monthly chart. You can see it stalling near these lows. December has been kind of a nothing bar. November was a deeper low. You can see we're looking for global assets to kind of find a base here. That's what I'm looking for overall. This does not show a lot of selling pressure right now. So this weakening trend that we just saw and this fear index increasing slightly is not translating into the charts as far as downward trending yet. Could happen, but we're not seeing real downward trending yet. The large cap index is doing the same thing. Very tight little doji bar here for December. We're halfway through December. I'm kind of thinking large cap might move a little bit higher, try to maybe put in a white bar here. We're getting close to the end of a depreciation cycle phase. We got a couple, 3-4 more months to go, which means we'll start an appreciation cycle phase. Appreciation phases can be fairly powerful. You can see them here. They can be sideways as well, so be aware that you can get a sideways kind of a trend. But when we look at downward cycle depreciation phases to upward cycle appreciation phases, this is where we get into a fairly strong downward cycle phase here. We might see a reflation trade here, and these cycle phases are typically about 13 months here. So this is a short-term appreciation depreciation cycle phase. Now, the consumer index chart. Okay, consumers are pulling away. Why are consumers pulling away again? Well, the Fed keeps raising rates. House prices are decreasing. Rates and credit card rates are increasing. Consumers are basically repositioning at this point. We need to see what happens with the Fed. We need to see what happens in 2023. A breakdown from these low levels of consumer, particularly down here in this low level, would be, I would say, disastrous for the economy. This would move us into a very strong recession, and the Fed would likely pivot at that point if the consumers were to move down lower. Now, it may take something like a deep low catalyst type of event to come into play, but I am still under the belief that we are going to have a support system with the consumer because, again, I'm still seeing, well, let me put it this way. There's two levels of consumers. There's the at-risk consumer, which is struggling, and then there's the let's call them upper middle class consumer, which still has a job, still spending money, still doing fairly well, even though the at-risk consumer is struggling and the markets are tightening. There's still a number of consumers out there, probably 60-70%, that aren't really feeling too much pressure right now. And because of that, I think we're kind of just weakening into the end of the year, and 2023 is going to be a brand new year. I think it's going to change perspectives, and we need to see how this holds up. But ideally, ladies and gentlemen, if we see consumers really tank in 2023, where this breaks to the downside, then we need to start readdressing our long-term thinking about what 2023 is going to look like and a broader unwinding in the global market. Right now, I believe that the markets will continue to tick along, and this is just an excessive end of year kind of a breakdown, kind of a washout low. But we do need to be aware that consumers are weakening. We've seen this downtrend. We wanted to see it kind of flatten and hold up. We do need to see how this plays out near the end of the year. So got a couple more weeks to go. But consumers right now are pulling away from the economy, which is going to hurt GDP, which is going to bring down inflationary trends, which is going to hurt housing and car sales. But I will tell you that, like I said, that's what the Fed wants. That's what the Fed is trying to do, is take away the speculative side of the market, and I believe they're doing a very good job of it right now. We just don't want to see this get much lower because that could put us into a stronger recessionary type of a trend. And lastly, the cash flow index, which is showing us how cash is moving in and out of the markets. You can see here that we had an accumulation phase, and now we're stalling out. We're back near these COVID highs. We need to see this kind of resolve itself into the end of the year. I do believe we're going to stay up in this area, this 1.3 to 1.47 area throughout the end of the year, and then move into a bit of a upward trending up into 1.5, 1.6 area in 2023. I think it's just a matter of, like I said, waiting out the consolidation and the fear factor that's taking out here at the end of the year. And I think once we get into early 2023, I think you're going to see a flood of capital move back into the markets. Remember, 60 to 70%, actually more than that, 82% of all U.S. workers aged 21 to 45 are all actively engaged in the workforce and are earning, saving, buying, and contributing to their investment and retirement accounts. So that is approximately 155 million people that are actively engaging in the economy. It would take something moderately severe to disrupt that. So when you start seeing, so-and-so's laying off 2,000 and 3,000, what have you, remember, we've got 150, 160 million young adults, 21 to 45 roughly, that are actively working and engaged in the economy. And when you start talking about a few thousand here and a few thousand there compared to 150 million, you're talking about 0.0001% of a workforce being laid off. It's not horrible, but we do need to see this reflation trend stay, and I would like to see this move above this red line. This cash flow index above this red line would indicate that we're starting to see some real accumulation in the market, and that's probably going to happen in 2023. Yeah, I think that's it for now. Yeah, a little bit of a long video, but I want you to be aware of what's actually happening. So we're actively protected. As I mentioned to you, the rotational modeling system has kept us protected for more than 2 years now and caught us in the right side of the trend. We caught a nice rally here. We were fully invested through this. Then come June, July, August of 2021, we got out, stayed in 80% cash. We've been safely protected throughout this downtrend, hedging against metals and staying in cash. Now we're starting to see a bit more of accumulation. We're at 20% investment capital, 25% metals, 55% cash, 0% or 0% bonds. And like I said, we look like we're moving into a reflation trade area. So we could see things change over the next couple of months into 2023. So follow me, follow my research, share with your friends, and get ready. 2023 looks like it could be a very powerful year for all of us. All right, guys, talk to you soon.